Welcome to the Business Extra podcast. I'm Mustafa Alrawi, Assistant Editor-in-Chief with The National. With me is co-host and The National's feature editor, Kelsey Warner. Hi, Kelsey.
Hey, Mustafa.
It's good to be here.
It's good to be here as well. And, both dressed like sailors today. Off we go.
Excellent. With a kind of maritime feel, although the conversation today has nothing to do with naval themes. It's more about carbon trading and very much how in the last few years in particular with the drive to net zero, post-Paris climate deal, how different tools are becoming popular, not just for corporations, but individuals as well, to offset some of the carbon emissions that they cannot necessarily reduce.
Exactly. And Abu Dhabi made news in the past couple of weeks because ADGM, its financial center, announced that it had partnered with AirCarbon exchange to create the world's first regulated carbon trading exchange, which I think got us here in the newsroom to pop our heads up and say, carbon markets, something we've thought about, talked about for the last couple decades, as you pointed out prior to us starting recording here. But I think it's an idea whose time has arrived, and it's time to better understand it and come to grips with what it is and how it works.
Well, I'm definitely interested in hearing more about where this goes, and also maybe to the uninitiated to go through a little bit of the history as well. But before we do that, I'll ask you to subscribe to this episode if you can. So thank you very much for that. Okay, now the housekeeping's out of the way. I want to introduce William Pazos, Bill Pazos, the co-founder and managing director of AirCarbon Exchange. He's joining us from London. Bill, thanks for joining us.
Thank you so much for having me.
Your business, you're sitting in London, but it's a business that is working in Abu Dhabi. It's working in Brazil. It's working in Canada. It's very much a global business. And does that represent at the moment where the carbon trading market is?
Yes, I mean the trading is very centered around Europe. Europe has sort of blazed the trail for the carbon markets from its early days, but the supply of credits is very much global, and you can basically follow where the world has more forests to save. That's where you're going to see a lot of activity.
I mean, I think your answer was great. You reached a natural conclusion, but maybe we can also pick up on the fact that, what is, maybe you can also, explain for me, what is carbon trading also?
Sure. Well, I think that I'll give you a little, excuse me, I'll give you a little background in terms of how carbon markets sort of developed, and that will sort of set the stage, and then we can go into what actually carbon trading is. So the origins of the carbon markets go way back to 1992 at the Earth Summit in Rio, and that was the first time that countries got together and agreed in unison that climate change, one, existed, and two, that it was a result of human activity. And it wasn't actually until 97 on the Kyoto Protocol that those same countries came with a blueprint or a solution as to how they were going to tackle this problem. And that's sort of the origins of carbon trading. And what's interesting is that it was the United States, even though the United States has been sort of not a big participant in the carbon markets, but it was the United States at that time that promoted the idea of carbon trading. Because for those of us that have a little bit more gray hair, maybe recall the acid rain in the United States. That was cured. That problem was cured by creating a cap and trade scheme around SOx and NOx emissions in the electricity markets. And so the United States proposed this idea, well, if we want to mitigate and reduce the amount of carbon that's going into the atmosphere, why don't we create a cap and trade scheme so that we can sort of naturally progress to a lower carbon emissions, as they saw in the SOx and NOx business. So what is carbon trading? And so the carbon trading, the way it works is you have a company, and let's just say that company is emitting 1 million tons a year. So you cap their emissions, let's say, at 800,000 tons. So next year you can only emit 800,000 tons. So they have a problem, right? They have to reduce their emissions by 200,000 tons. Now let's say that they're very successful and they reduce their emissions to 700,000 tons, right? So now they've actually reduced their emissions over and above what their requirements. So they have a surplus of 100,000 tons. Now there might be another company that is trying to reduce their emissions, but they can only reduce their emissions down to, same example, let's say to 900,000. So they have a 100,000 ton problem. And so that company that was able to overshoot its goal can sell that excess to the second company. And so you create this carbon market. In order to sort of the carbon market, then in order to grease the wheels of the carbon markets, these companies may or may not be able to reduce their emissions to the level that they need to be reduced internally. So obviously, if you are Etihad, for example, you can't stop flying, so you can't stop emitting. So the carbon market allows Etihad to find the cheapest way of reducing a ton of carbon. So it may be that they find a forest in Africa that's being threatened with deforestation, and they use their money to protect that forest. That forest, then, the way it works is you quantify how much carbon is in that forest. You figure out what the deforestation rate of the forest would be, right? So if we don't do anything, how quickly would this forest disappear? And then, so let's say there's 1 million tons of carbon in the trees and branches, et cetera, and it's going to disappear in 10 years. Well, that means that every year it's left standing, you've saved the world from an additional 100,000 tons of carbon. So you get that process registered, and there's registries that issue you a carbon certificate that says you've saved those 100,000 tons, and those can be used by Etihad to net reduce their emissions. So they don't need to do it internally; they can do it elsewhere. So the big advantage of the carbon markets is that it allows the economy to sort of grow, but at the same time, it incentivizes the investment in reduction of carbon at its most efficient levels. So I'm sorry if it was a little too long-winded, but
It was a very good explanation, actually.
Okay, but what you describe almost sounds too good to be true. That's a beautiful virtuous cycle that we just heard about, and it sounds though like and I know that this was why this was controversial in 1997 when Kyoto introduced a carbon market concept, and then again in 2015 when Paris Agreement actually put it in. These continue to be controversies because it essentially acknowledges the existence of carbon going into the air. It acknowledges the existence of greenhouse gas emissions, and also it seems to create a paradigm where just if you follow the rules, you'll hit your target. But how does this actually pull carbon? How does this actually pull the greenhouse gases out of the air? How does this lower emissions?
I mean, I'd add to that to kind of say, um, and maybe this is unfair, but I would add to say why hasn't carbon trading been kind of more successful? Essentially, it's such a good idea. Like, why in the real world hasn't it become sort of everywhere?
Well, it's had a cycle, right? So the first Kyoto phase was followed by the European was basic. The big engine behind the first Kyoto phase was the European emission trading scheme, and under the European emission trading scheme, the EU allowed for carbon credits to be utilized to offset part of the liability of these companies that were part of the EU ETS. And so that drove investment into carbon mitigating activities, which generated carbon credits, which were bought by these European companies and given to their to their regulator in payment for the carbon that they were emitting in the EU. But we had this thing, which was the global financial crisis. And the result of the global financial crisis in 2008 was that, for example, a company that was given 100,000 allowances, or in our example, I think we said 800,000, and then they were able to emit up to 800,000. Those companies were operating at 50% capacity, and they reduced their emissions of carbon naturally. And so the market was overflooded with allowances in Europe, and so the price of carbon collapsed. So there's zero demand around the world for carbon. On top of that, politicians at the time basically said, yes, climate change exists. Climate change we have bigger problems, right? We have economic problems. We can't look at this problem right now, which, by the way, is an interesting thing, because we've had the equivalent of a global financial crisis in the pandemic, and we've come out the other side in the carbon markets and in climate as well, as more of as a solution to get out of this problem than as something that we can't afford. So it's a very different paradigm from the global financial crisis and today. So I think all this talk in terms of carbon is definitely here to stay, and it's being seen as a solution, not as something we simply can't afford.
Do you think that period when it had its peak before the financial crisis, and associated with it at the time, I mean, anecdotally, I did hear of several schemes that went wrong for investors. There was a lot of hype around carbon trading, and so there ended up with investors losing a lot of money from less than ethical players in the market. Do you think that hurt the idea as well?
Well, the first thing that because I've been hearing that a lot, right, in terms of a sort of certain lack of integrity, a lot of problems, and I always sort of scratch the surface and I say, okay, well, give me an example. And there's actually one example that I know of, which was actually a tax fraud that was perpetrated in the EU around the trading of carbon credits. But it's not a direct function of carbon credits. It was simply a tax fraud. Other than that fraud, there aren't any other ones. There are, because for you to get a carbon credit, you have to take all of the information of the underlying project, take it into a registry, and go through a rigorous process of following the methodology, which is a blueprint on how to get to the point where you get carbon credits, measuring, et cetera, with auditors that are independent to yourself and all this other stuff. It's a costly and very transparent process. And then you end up with the carbon credit. So there's literally no example of fraud in those processes. What there is in the market is a library of methodologies that you follow to generate carbon credits that were put forth by the UN during the first Kyoto phase, that when judged with the knowledge that we have today, do not have environmental integrity, right? So you would get carbon credits back in 2004 for putting up a solar project in Vietnam. And if you look at that transaction today, you say, well, they shouldn't have gotten carbon credits for that activity because it was not additional, meaning carbon credits were not instrumental in the decision to make the investment. And I'll agree with that. But the rigor of following the methodology, et cetera, that was followed to the T. So we like every business, like every market, you have to improve the methodologies, become more rigorous over time, and improve. But I don't think there was a lot of fraud or.
Sorry, before you jump in, Kelsey, can I just clarify that for those listening? For carbon credits to be issued, a project must demonstrate that it wouldn't have been uh, funded otherwise if there wasn't the associated uh, carbon credit aspect to it.
That's exactly right. So that's the concept of additionality. So were carbon credits additional to you making the decision to invest in project X, right? And that's where a lot of the early projects within the Kyoto framework, sort of when we look at them from today's vantage point, sort of fell short, right? What projects would say, for example, let's say you were going to invest in a solar project in Vietnam and you were making an 18% IRR. Intuitively, you would say, well, if you're making 18%, the carbon credits, without carbon credits, why on earth would you need carbon credits? What these projects did way back then is they would say, well, you're not really looking, getting 18% in Vietnam is not the same thing as getting Vietnam 18% in the UK. The risks are completely different. There were a lot of project risks. There are a lot of other risks that we needed to mitigate.
I want to dig more into the work of what AirCarbon Exchange does, but first I just want to better understand, because you were speaking to this earlier, just how a carbon credit is measured, who's regulating it, who's actually providing the oversight as to how a credit gets generated.
Sure. So a carbon credit is generated when you do something over and above business as usual, right? So think of any activity. So let's not use forestry again. Let's maybe use something that's more common in the Middle East, for example. So business as usual would be that a particular oil refinery refines the oil and has a flue gas that emits certain gases while it's doing that. And a lot of these companies actually are capturing a lot of that gas, but not 100% of it, right? So that's business as usual. So a carbon project would be, why don't we go and capture that last 10% of emissions that are going into the atmosphere? That's not an economically interesting thing for business as usual activity, and so it's not done, right? So the first thing that the litmus test is our project going to be better than business as usual? So in our example, it is. So then you go there and you put in some kind of a stopper that where you accumulate all of this gas, and then you use the gas for creating fuel or additives or whatever it is. So you've prevented that molecule from going into the atmosphere. So what you need to do is you need to find a methodology within an approved registry. The largest registry is called Vera. It sits in Washington, D.C., but there are others. There's Gold Standard. There's one in Qatar called the GCC. So there's several registries. You go to the registries, you present your project, they approve your project, you get a project ID, then you do your project, then you send an auditor in to check that you did exactly what you said you were going to do. It's very important that you measure it and measure the reductions according to your promise under your registration, and only then does the registry give you the total number of carbon credits that you have mitigated. At that point, you can sell it to someone that needs to tell the world that they've reduced their emissions. So let's say Etihad buys those carbon credits from the project that was done in the oil refineries, and now they cancel those carbon credits. So no one else can then say it. So by that carbon credit, what it does is Etihad can now say they financed that project, right? Because they bought those carbon credits. So that's the cycle.
So I want to bring in the work of the exchange now, because it sounds like this is about where an exchange like yours would come in. So AirCarbon Exchange, you securitize carbon credits into fungible and tradable securities with transparent pricing and real-time trading. So take a big step back and actually tell us what that means. What does that look like?
Well, our innovation is basically a very simple innovation. We looked at traditional commodities, and we realized that the carbon markets were trading incredibly inefficiently. So in our example of the flue gas recovery, the seller of the credits traditionally would be doing an over-the-counter transaction. They would be flooded with brokers that would be taking 20, 30, 40% of the carbon credits and big bites of the apple, if you will, to find buyers. So there was this ecosystem of brokers that were taking anywhere from 20 to 40 to even 50% of the economic value of the transaction, because carbon credits were trading like paintings, right? So every time someone had to sell a carbon credit to someone else, they would have to tell them the whole story of the underlying project. If you look at traditional commodities, the way they operate, soybeans is my go-to example. The soybeans sit in a warehouse, and what trades on the exchange are digital receipts. So what we created was that same concept, but for the carbon markets. So instead of having a physical warehouse, we create a trust. We define the kind of carbon credits that can be in that trust. So let's say we create a trust that only accepts carbon credits from forestry projects, right? So if you have a carbon credit that's eligible under forestry, you put it into the trust, and we give you a digital receipt on the exchange. Now there's a tradable instrument on the exchange. No one needs to ask questions about the underlying project because they know it fits the definition of that receipt. So now thousands of projects can trade very quickly, very efficiently, low cost, transparent pricing. And that's what we brought to the market, right? That was our innovation.
So I want to ask, if I, want to offset my family trip this summer because I can't avoid taking a plane, or I bought some Bitcoin and I'm feeling bad about the energy intensity of the mining of the Bitcoin that I bought. Can I buy credits on the exchange as an individual, or is this something only for corporations to use, like VW or Audi?
Yeah, we're very institutional focused. We do have some individuals on the platform, but they must be accredited investors. And so I believe that's a threshold of at least $2 million in liquid assets. So we don't focus on anything retail.
So it's still, would you say that this is still the domain of both the sophisticated and the institutional investor at the moment?
Actually, that's what I think is it's actually not, it's not even that, right? So there's literally trillions of dollars in the hedge fund industry that's sitting on the sidelines, and they know that we should be going long carbon because we're moving into a carbon constrained world. But when they before we showed up, they would do the research, and they would see that if they were to invest in this asset class, they would have to buy carbon from a forest X. And is that a good deal? Is there a good price signal? Could they do a mark to market? So all of those things that fund managers and asset managers look for before they invest in a project or in a sector was simply not there. So that's what we've created, right? So we're looking to unlock those institutional investors, which is, frankly, our biggest contribution to climate change. If we're able to unlock that capital, it's going to flood the market. Price of carbon is going to go up. And if the price of carbon goes up, more investment will be done in carbon mitigating activities. So that's our sort of, I like to think of that as our contribution.
So I understand that there is that carbon credits help sort of fund um, activities, whether you use the example of the forestry or otherwise, to help offset the global emissions that are out there. But you also use this phrase "carbon constrained world," and this comes to these commitments, particularly in Glasgow last year, towards net zero, and even the UAE is setting 2050 that will work towards net zero. Now, net zero, as I understand it, and forgive me, I'm not an expert, or I'm telling you something you already know, Bill. But the idea is that you reduce the carbon that you produce, or you find a way to be more efficient when you're producing it. And there are different things that you can do. I mean, obviously, there's you can buy credits that offset that, but that seems to be one tool in the arsenal. You can also do carbon capture. You can also, technology is being developed to literally suck carbon out of the air, but also operations themselves, whether you talk about an airline running on sustainable fuel would make a big difference. So in a world, if we say that everything's going to go well and carbon is going to be reduced, how does that affect the market for carbon trading down the line if there is less carbon being produced in total?
Yeah, I mean, if all goes well, um, the price of carbon will go to zero because the cost of mitigating a ton of carbon also goes to zero, and we find different fuels. We change our activities. The direct air capture, what you just alluded to, which is commonly referred to as DAC, is a process where you simply capture the carbon molecules out of the atmosphere, maybe solidify them into some kind of biochar of some kind, and then either bury them or put them into cement, which goes into permanent structures. So that's a net reduction in carbon in the atmosphere, and that is the future, right? But today, for you to do a DAC project, you're talking, you need to sell carbon at least $1,000 a ton for it to begin to be of any economic benefit, right? So that technology will get to a point where we can do it in scale and inexpensively, but the reality of the matter is that we're not there today. This may sound a little sort of negative. I'm very negative in terms of humanity's ability to not reach that 2% temperature increase that's bandied about. I'm very negative in the short term, but I'm very positive in the long term in terms of humanity's capability to win the battle against climate change. But I think in the medium term, we will blow right through that 2% very quickly.
Sorry, 2 degree, right?
Yes, 2 degree. We're going to blow through that very quickly. I believe we're going to be faced with some, and we're already seeing that we're going to be faced with, some, with climate refugees and flooding and economic issues as a result of climate change. And then, Mother Nature will coax us into acting more responsibly, and we'll turn that corner. But I think we are going to get much closer to the edge before we break the cycle. And so, carbon trading, I hope one day will disappear. but it is essential in the short and medium term.
I mean, is it in some ways equivalent to the use of natural gas as a kind of bridging fuel, until we can get enough scale on renewables and we can find alternative, cleaner sources. Even though gas is much cleaner than other fuels, coal, oil, it's still not considered, completely, you know, green. And so in the same way that carbon trading, carbon credits will also be a bridging tool to kind of get us there now while we don't have the other mechanisms in place yet. It's almost like, a couple of weeks ago, the message, I think it was at the Global Energy Forum the Atlantic Council had, which is, don't unplug from the current system until the new system is built. And so is carbon trading sort of a bridge to that new system until we get there?
Yeah, I believe it smooths the transition, right? So what's important is that countries push the cap down over time. If they keep the cap in one place and they just allow business as usual, then there's not a lot of incentive for money to go towards climate mitigating activities. So countries need to tighten the screws in order to do that. So that's very important, and you're seeing carbon taxes popping up in different jurisdictions around the world. So that's very much happening.
Mustafa asked a sort of long-term, long-range future question, but I want to end on a shorter-term future question, which is the International Institute of International Finance has put the potential carbon credit market at worth $50 billion by 2030, which seems, you think that like Apple is worth $3 trillion, seems low. What do you think? Seems like a small potential, actually.
I think that's a very small number. We're looking. McKinsey's talking about 2 billion tons of carbon being traded. So it's even those numbers really don't make much sense. If you every time a company talks about net zero, and you add all of those countries up, it's current size of the carbon market is 0.2% of that promise, if you will. So it has potential even in the medium term to just explode in terms of the amount of carbon that's necessary for us to transition there. But I think you touched on the DAC is an important thing, and an analogy that I always that I thought of, that I wanted to sort of leave you with is this idea of a bathtub that's being filled with water, right? It's very important that you reduce the trickle of water in order to not have it overflow very quickly. But even if you reduce the trickle, it's still going to overflow. So what's really important is the DAC that you alluded to earlier. We need to figure out a way to take the carbon that's in the atmosphere out. Not only reduce how quickly we're increasing it, but actually take some out and ensure that it doesn't overflow. All of that is being addressed by the carbon markets in the form of price signals. So if you're able to do a DAC project, there are people out there that are willing to pay you $400 a ton. If you do a forestry project, which is more common, less costly, it's trading at $10 to $12 a ton. So there's the market forces are pushing you to make investments into this more important activity.
So if you back, climate change, but at the same time you want to also underestimate humanity's ability to help itself, then perhaps the carbon market is the place to explore. Bill Pazos, co-founder and managing director of AirCarbon Exchange, thanks so much for being with us, for talking to us, and for educating us today.
Thank you. It's my pleasure.
Thank you. Well, that's it for today. Kelsey Warner, thank you so much.
Thank you.
All that remains to thank our production team, Gali Burrows, Mahmoud Rida, Aisha Khan, and you all for listening. Do join us again next time.